So here's a number that shouldn't make sense. The Dallas Cowboys are worth $12.5 billion. Highest revenue in the NFL, $1.27 billion a year. And yet, on paper, in a given year, that franchise can show a loss, not a small one. A real, filed with the IRS, this business lost money loss. That's not a hypothetical. Jerry Jones bought this team in 1989 for $140 million, and for a stretch right after, the team was reportedly losing $1 million a month. $1 million. A month. If you saw that operating statement cold, you'd think you were looking at a business on its way to bankruptcy. Instead, that same franchise is now valued at north of $11 billion, not despite the losses. Sort of alongside them, year after year, in a way that should feel contradictory and somehow doesn't, at least not to the people writing the checks. Here's the part that should bother you. This isn't a story about a bad decade that turned into a lucky decade. Teams across the league do this on purpose, every single year, whether they're winning the Super Bowl or missing the playoffs. The Premier League, for comparison, had 5 teams lose over $60 million each in a single season, genuinely bleeding cash. The NFL, meanwhile, didn't have a single team lose money in 2024, not one, and some of them still reported a loss to the IRS. So which is it? Is the team making money or not? And if it's making money, why does the tax return say otherwise? That's the paradox sitting at the center of every professional sports franchise in this country. The games sell out. The media deal is worth more than most people's cities. The merchandise, the sponsorships, the parking, the beer, all of it is flowing in. And somehow, on the one document that determines what the owner actually pays the government, the team looks like it's underwater. It's not bad management. It's not a rigged salary cap, though the cap does help. It's not even really about football, or basketball, or hockey at all. There's a mechanism buried in the tax code, built specifically around how you're allowed to value a professional sports team, that lets an owner write off the entire purchase price of the franchise, as if the players themselves were quietly losing value every year they played. Genuinely, as if LeBron James depreciates like a delivery truck. So let's actually read the operating statement, line by line. Because this is where the trick lives, and it's not even hidden, it's just written in language nobody bothers to translate. Line 1. Roster Depreciation Allowance. The tax code lets an owner take the entire purchase price of the team, the whole stadium deal's worth of dollars, and spread it out as a deduction over 15 years. Buy a franchise for $1 billion. And for the next decade and a half, you get to subtract a chunk of that billion from your taxable income every single year. Not because the team lost value, because the tax code pretends it did. Line 2. Revenue sharing deductions. Leagues like the NFL pool national TV money, licensing money, sponsorship money, and split it across all 32 teams before anybody even sells a hot dog. Sounds generous. It also means a huge slice of incoming cash gets routed through the league office first, showing up on the books as an outflow before it ever becomes local profit. Line 3. Stadium costs. Even when taxpayers foot most of the construction bill, and in a lot of cities they genuinely do, the owner still books financing costs, maintenance, debt service, all of it, as expenses against the team's income. So you've got public money building the building, and private losses being claimed inside it. That's not a conspiracy. That's just how the ledger's built. Now stack all 3: depreciation, revenue sharing, stadium debt. Add them up, and on paper, a team that's selling out every home game and cashing 8- and 9-figure media checks can report a loss. Genuinely. That's the paradox. The accounting isn't lying, it's just measuring something that isn't cash, it's a construct. And here's the part that makes it click. No NFL team lost money in 2024. Not one. Meanwhile, 5 Premier League clubs lost over $60 million each. Real losses. Real cash out the door. Because European soccer doesn't have the salary cap or the shared national TV deal propping everything up. Same sport. Different plumbing. Wildly different results. So if the loss isn't real, where does the money actually go? Here's the number that changes everything. The Roster Depreciation Allowance lets an owner write off the entire purchase price of the team over 15 years. Not the stadium, not the equipment. The whole franchise, treated like it's decaying, like it's a fleet of delivery trucks losing value every year. A team that's appreciating in the real world gets to pretend, on paper, that it's falling apart. And that paper fiction has a cash effect. It shields real operating income from taxes. Ticket sales, sponsorships, media rights, all of it can flow in, and the depreciation on the books cancels it out for tax purposes. The owner isn't paying income tax on the team, not some years, most years, often none. So where's the tax bill? It doesn't disappear, it moves. It gets deferred all the way out to the sale. And when it finally shows up, it doesn't show up as income tax at that top rate, it shows up as capital gains, taxed lower and only once, on a single transaction, decades after the check started clearing. That's not an accident, that's the entire design. Meanwhile, the value of the thing keeps climbing in the background, completely untouched by any of this. The depreciation on the tax return has nothing to do with what the team is actually worth. Those are two separate universes that just happen to share a name. One says the team is worth less every year, the other says buyers are lining up to pay more for it than they did 12 months ago. Genuinely, look at the Cowboys. Jerry Jones bought the team in 1989 for $140 million, and for a stretch after that, the thing was reportedly bleeding $1 million a month. On paper, a disaster. In real life, he was sitting on what's now valued at $12.5 billion. The most valuable franchise in the league, pulling in $1.27 billion a year in revenue. That's not a typo, and it's not a turnaround story either. It's the same mechanism the whole time. Losses on the return, gains in the world. So the owner isn't getting rich off this year's box score. He's getting rich off the appreciation compounding quietly, untaxed, year after year, while the tax return tells a completely different story to the IRS. That's the part the pitch never mentions when people talk about buying a sports team like it's a rich guy's hobby. It's not a hobby. It's one of the most efficient tax structures available to anyone in this country, and you don't need to sell a single ticket to benefit from it. But here's the question that actually matters, and it's the one nobody asks at the press conference where some billionaire says he's buying the team for the love of the game. If the money isn't made by running the team well this year, when does the owner actually get paid? Because there's a day where all of this, the depreciation, the deferral, the paper losses, get settled. And that day is a lot more interesting than anyone lets on. So let's answer it. When does the owner get paid? He gets paid the day he sells. Everything before that, the ticket revenue, the media deals, the depreciation write-offs, that's just the holding period. It's not the business, it's the runway. Here's the mechanism again, but watch how it ends this time. The owner buys the team. He depreciates the entire purchase price over 15 years. On paper, even though the roster isn't actually losing value, it's usually getting more valuable. That paper loss offsets real income. So year over year, the tax return says he's losing money. The bank account says something completely different. And because there's no annual taxable income to speak of, there's no annual tax bill to speak of either. Taxes aren't avoided, they're postponed. Pushed down the road, year after year, compounding quietly, until there's exactly one taxable event left, the sale. And here's the part that makes this whole structure make sense. When he finally does sell, he's not taxed at ordinary income rates, the rate you and I pay on a paycheck. He's taxed at capital gains rates. Lower, sometimes half. So the entire economic story of owning a team gets funneled into the one moment that's taxed the least. That's the paradox, laid all the way out now. A business that shows a loss every single year isn't broken, it's positioned. It's been quietly deferring and converting its tax bill for over a decade, waiting for exit day. And exit day is where the actual number lives. Look at the Cowboys. In the 1990s, Jerry Jones was reportedly losing $1 million a month running that team. $1 million. A month. On paper, an active disaster. Today, the Cowboys are worth somewhere north of $12 billion, the most valuable franchise in American sports, pulling in over $1.27 billion a year in revenue. So which version was true, the guy losing $1 million a month, or the guy sitting on the single best investment in the history of professional sports? Both. At the same time. That's not a contradiction, that's the design. The scoreboard was never the ticket revenue. It was never even the annual profit and loss statement. The scoreboard is the valuation, ticking up in the background every single year, completely detached from whatever the tax return says. You're not buying a sports team. You're buying an appreciating asset with a really entertaining tax shelter attached to it, and the games are basically the marketing department. So when the loop asks how a team can lose money every year while its owner's stake triples, the honest answer is, it was never losing money. It was losing money on the one document specifically designed to say that. Everywhere else, the number was only ever going up. If this is the kind of thing that actually explains where the money goes instead of just repeating the pitch, subscribe, there's more of this coming. And if you've got a number you want run down like this one, drop it in the comments.